Let's talk about infinite banking before you're 40. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's episode, let's talk about infinite banking before you're 40, or generally a money message for folks before they're 40. So this year, 2025, I myself turn 40. It's incredible. I feel like I'm just getting started in life, and yet I know in looking back that I've experienced so many things that give me a lot of reflection that I want to share with you. So let me just start by getting us in a certain mindset. Do you remember 2005? I know you do. You immediately think of something. There's some song, there's some place, there's some faces. There's just things that are going to jump in our mind. For me, I know what it is. I'm thinking about college. I'm thinking about the careers that I'm wanting to learn about and pursue. I'm thinking about travel abroad. I think about working summers to be able to take my girlfriend, now wife, mother of our children, on dates. So it was not that long ago that it was 2005, but today it's 2025. So time goes by fast. I'm here to reflect and share some best practices with you. So first and foremost, I teach people how to live and leave a lasting legacy. So let me just start with the end in mind, that leave a legacy right out of the gate. It's my core belief that you are your most valuable asset. So it behooves us to protect the asset that will lead to all the other assets, investments, businesses, relationships, etc., families that we're going to have. Everything else is going to stem from the life. Everything is going to stem from that life that we have. So thank the good Lord for it. Let's protect it right out of the gate. I'm a big believer in guaranteed protection. I personally actually owned whole life insurance privately, not the stuff that you have through work. I had work coverage, of course, when I was a high school Spanish teacher in the state of North Carolina, when I was a law enforcement officer in the state of North Carolina. I had coverages through work, but I, as a young husband and father, decided I wanted to privately own, because I'd had more than one job, and those job coverages didn't necessarily go with you when you left. So I knew that I personally wanted to have coverage, and I bought whole life insurance because it was going to last my whole life. I knew it had guaranteed cash value. I knew that you could receive a dividend. I knew that you were going to have that guaranteed, most importantly, talking about leaving a lasting legacy. I knew it was going to have that guaranteed income tax-free windfall to my wife, to my son. I got policies on everybody in the family before learning about. Now just ignore this. Here's where I'm at as a father. I am beta testing. That's what I'm saying anyway. I'm beta testing gifts for our son. So my son's not seen this. Josiah's not seen this, but it's going to be his. He's got a birthday coming up. But I'm saying that I got whole life insurance for me, my wife, and our first son, Jacob, before I ever read about becoming your own banker, how you could use whole life insurance, because I just knew about the guarantees, the death benefit, cash value, etc. I knew about those advantages. So again, you're your number one asset. Protect that asset. Everything else will stem from your life. It's not an if game when it comes to life and death. It's a win. So since we know that we will graduate from this life to the next, then we should cover this one with guaranteed protection. We have home insurance, car insurance, phone insurance, okay? For if situations, for the when situations, we should definitely have coverage. Moving on, let's talk about the living a lasting legacy part of what I do here, which is teach people how to live and leave a lasting legacy. So the more likely scenario, of course, is that we're going to live long, full, and hopefully productive lives. I believe that if we can keep, this is very simple, if we could just simply keep what we earn, we will automatically beat our peers. We will automatically beat our own selves. We will come out on top than if we didn't keep what we earn. It's that simple. If we could keep what we earn, I don't care if you're earning $10 an hour or $10,000 an hour, if we can keep more of what we earn over our whole life, I'll use that right there. I probably will again. Then we're going to obviously be more profitable. We will be wealthier. We will create a bigger legacy, and we'll be living out a greater legacy by keeping more of what we earn. I help people do that. I help people keep what they earn, which leads me to talk about what we're told to do with money. What are we told to do with money? Well, we're told to go earn it. Great. Awesome. We're told to go work for it. Let me say right out of the gate that there are two ways to earn money: people at work or money at work. We're taught and told to go to work in a career, maybe a business, not so much in business, but you folks are out there paving your own way. I love it. We're told to go work for money, but we're not taught, we're not told, we're not encouraged to go out and put money to work. So let's just talk about the earning part for getting started. When you earn, what happens to that money? Well, probably some taxes have been taken out of this money. That's a big deal. Think about this with me. When you earn an income, it's taxed. With whatever you have left over, when you buy something, there's typically another tax. Remember this, the consumer pays for everything. Everything. When you own that thing that you just bought, you probably have some form of continued taxation on that. You still have to pay taxes on the cars that you own, on the property that you own, etc. We own vehicles outright. We own our property outright, but we still have to pay taxes on those pieces of private property. So I'm just saying taxes are a reality that we should address. If you are typically receiving a tax refund, this is just a suggestion. This is not financial advice. Do not sue me. If you are typically receiving a tax refund, ask yourself one of two things could be a very important question here. Number one, are you giving too much to Uncle Sam for a year without charging anything for it? Are you paying too much and then getting it back after Uncle Sam got to use it for a year without paying you any interest? That's a problem to me. Perhaps you need to talk with HR wherever you work and see about changing that so that you could have the use and the profitability of having access to your money for the course of the year. Think about that. And then also, if you are legitimately receiving and I'm tentatively using that legitimate word, that would lead us to a big conversation about government and overreach and private property and rights, etc. But if you're getting a tax refund, if you got one last year, the year before, how much of that money do you still have today? Remember, I teach people how to keep the cash that flows into their lives. I teach people how to keep it, no matter how you experience it. Do you have any of the money from a tax refund from last year or the year before or the year before? What if you could have kept it? We'll talk about how to keep it. But I'm just trying to broadly discuss taxation here. It's a big problem that needs to be addressed. Now, how about inflation? Remember how I was asking you about, do you remember 20 years ago, 2005? Well, think about the types of things that you were buying in 2005. How much was that thing? All right, so probably you were buying smaller ticket items than you perhaps are right now. I mean, there's a big difference between buying the next PlayStation game versus putting 4 tires on the car. Big difference, right? Or the washing machine goes out. You know what I'm talking about. So number one, are things going up? Inflation. That's what I'm discussing. Inflation. We need to be addressing inflation with our cash flow as well. Because even the same things, aren't they probably costing more now, 20 years later? What might they cost 20 years in the future? Should we prepare for that? Can we prepare for that? Yes, especially if we're keeping more of our money now. Then we'll eventually end up talking about growing it, compounding it, using it, etc. But here we go. Inflation, it's something that we need to account for. Now, we've talked about two of the big ones, right? Like taxation. I mean, if that's a third, which is, I mean, that could be the case. If that's a third of every dollar that we're earning, right? Inflation, if we've got another percentage of that dollar where we're already paying taxes and now that's gone as well, we're losing, okay? Now let's talk about the real silent killer. Approximately 34.5 cents of every dollar that we earn goes to interest on things we finance. Now, here's the deal. Everything is financed. Either I am using credit or cash. All right. Credit means we're asking to use someone else's money on their terms and conditions if they approve us. Once we fill out their paperwork, pay them interest for it. They hold collateral over our heads, etc. That's it. Credit. The other route of financing things is to pay cash, to save up that money. Can't use it. Got to save it up. Save up that money, and then we liquidate it. We spend it all. It's gone forever. And we cannot earn interest on that money like we otherwise could have. So either, because everything is financed, either we pay someone else interest or we lose interest that we could have otherwise have earned, which leads me to this third compounding word. So here's how we can finance, because we're going to buy the cars, we're going to buy the homes, we're going to take vacations, we have taxes to take care of, stuff, college, so many things. Everything in life is financed. We don't have to pay credit. We don't have to pay cash. We could compound. We could keep, I'm going back to that word, we can keep our money, grow it, compound it in a guaranteed fashion, and still use it for the things in life that we're going to finance, that we're going to buy. So remember that everything that you buy is financed. Everything that you purchase is financed. Credit, cash, or compounding are the options now. Now, ultimately, money is going to flow to us and it will flow from us. Now, first and foremost, I'm saying consider adding one step to what it is that you're already doing, which is implement this concept of infinite banking. Add one more step to what you're already doing. You're already buying things. Change the direction of the cash flow to a private banking system of your own, and then pay for the vacations, and then pay the property taxes, and then run your business, and then manage your household like normal. Whatever it is that you're already doing, add that one step to what you're already doing. Change the direction of the cash flow to keep your money for the rest of your whole life. And to be plain, where I'm saying to put that money, as you'll learn about in this book, Becoming Your Own Banker by R. Nelson Nash, or from anything on my channel, is a properly designed whole life insurance policy from a mutual life insurance company that pays dividends. That's the place to build capital for your whole life, where you can grow it, compound it, have access to money for the things that you were going to do anyway, but it's a private piece of property that is a tax-free environment, meaning that you can have compound growth in that policy and yet have tax-free access to capital from that policy. And because of that compound growth in the policy, that's a great hedge against inflation. So again, those are the big areas where we're losing money typically, especially early in life, okay, when we're just getting started. The taxes, the inflation, and the interest on things that we're buying. We can account for all three of those with this private monetary system of owning a properly structured whole life policy from a mutual company that pays dividends. So again, money will eventually leave us for the things that we're going to do in life. Now let's talk about some structure when it comes to just managing your affairs. I feel like I've got great scripture to back a lot of these principles that I'm going to share with you. If that matters to you, whether we're talking about a good man leaves an inheritance to his children's children, the workman is worthy of his hire, oil and riches in the house of the wise, count the cost of the tower before you build it, don't bury your talents, be a good steward. That's actually the purpose behind the name Durham Talents, is I feel that we're conventionally told to bury our talents. And I don't believe that we're supposed to do that. And it's definitely not to our benefit. It's definitely not us being good stewards. So if you care about those references, there they are. That's part of my come from for sure. That's my primary foundation on looking at life, to include infinite banking. Now, tactically speaking, again, I'm hitting on debt. If you have consumer debt with a third party, watch this. Think about this. You're promising that entity. That's not your family. That's not your business. All right. You're promising someone else future earnings that you and your family have not even experienced yet. You're financially enslaving yourself to that person for next year, the 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 next year. Okay. Look at your car notes. Look at your house notes. I dare you to go and calculate how much you spent last month in interest. I'm saying that lovingly, but strongly. I dare you. I bet you won't do it. But if you do, you'll be a good kind of mad. You'll be a good kind of mad. You'll be furiously productive, I hope. I dare you to look at the number, how many dollars you paid on all the things across the board, out of your car payment, out of your mortgage, out of everything. I dare you to look up how much last month you paid to a dollar amount in interest alone. I dare you. So again, if you're in debt to someone, you're promising them your future earnings that you've not even experienced yet. That's so strong. If you can stay out of that, you'll win by default. Whether you actually implement infinite banking or not, you will win by default compared to what you otherwise would have done or your peers around you that are falling into that pit. And I promise you, these are the kinds of things that I hope that my children and my grandchildren, see, I'm saying these things to my family. This is for them. It's for you too, but it's for them when they get to this message, for them to hear this, because these are the kinds of conversations that I did not have the benefit of when I was living life 20 years ago. So it's a big reason behind why I'm doing it. Staying out of debt is so huge. Axe the debt in your life. So here's one way to put it. If you don't have the money to buy what it is that you're thinking about buying, to pay cash for it, you don't have enough. Some people would even say, and you draw this line wherever you want. I'm not here to tell anybody what to do. I am trying to provoke some thought here. And I am encouraging you to consider how to live and leave a lasting legacy with infinite banking, how to simply keep everything that you earn. But perhaps you put some other gauge on yourself where you say, well, I won't buy that thing. I don't care if it's another pair of shoes, whether it's a vehicle, whatever it is, that vacation. I won't pull the trigger on that until I could do 2 of them. That way, come what may, you're still going to be well grounded. Again, on spending, let me just say to plan ahead. Some people don't even like the word budget. If budgeting is something that you should do, like to do it, okay? And I don't care if you use an app on your phone. I don't care if you go old school spreadsheet. I don't care if you write something out. Lauren and I do meet once a week to go over our earnings, to go over our expenditures, to go over our plans, to even just look in our calendars and plan ahead of where we've got to be, when, etc. each week upcoming. So we look back at what we did, needed, used, etc. over the past week, and then we're looking ahead into the future week. And then we have larger family meetings at other times. But once a week, that's what works for us currently. It's not always been the case. We've had that dialed in different ways over the years. We're coming up on 18 years married, by the way. Here's where I'm at in life. 4th baby is on the way. This is the year I turned 40 years old. My wife and I have been together, courting included, 25 years this year, married 18. She's my high school sweetheart. Incredible. Here's where we're at. But having meetings, having a budget, just planning it ahead. That's my encouragement. You plan it how you think that you should. But plan it. Be proactive about it. which does lead me to my next point, which is have an emergency fund. You've probably heard this, but I'm going to say it. And I've been in this situation in my life. My goodness, so many highs, so many lows. I've been in that situation where I might not have had the $500, $1,000 for a medical emergency. Have you heard that? That like 9 out of 10 people don't have $500, $1,000 for a medical emergency. And as a father, having made a trip to the ER with a child, that's not fun. That's not a concern that you want to have in the back of your mind while you're trying to stop the bleeding and get somebody where they need to be. Okay, that's not the case. Actually, that would be for the same son that this is going to. Interesting. Be bold, my son. Be dangerous. Be brave. Be kind. I love you. So have an emergency fund. Have a war chest. And if you need to start with that first $1,000, and I've had these conversations with friends, clients, all kinds of folks where it just came up and we're talking about having that emergency fund, that starter emergency fund even. And I love getting feedback from folks where they say, I'd never done that before. After that conversation, I did it. I've maintained it. Sometimes we've had to use it, but we build it back up. And I love that. So have an emergency fund. And again, here's another place where you can draw a line in the sand. Save that first $1,000 as soon as possible, of course. But after that, what do you think is appropriate for you? Should you have 3 months? Should you have 3 years worth of expenditures? Now, that's big. But I know people that go that route. Okay. So whether you pick 6 months, 2 years, 1 year, eventually, I just think that you should build up to a war chest of capital for yourself. Build that kind of a financial fortress for yourself. Now, I've got an ideal place where I think we should be building that type of capital for sure. I mean, I would suggest always that somebody have accessible, liquid, 24-hour kind of money. But if it's 24-day kind of money, and it doesn't take that long, but I'm saying that we probably want to be putting our 6-month emergency fund as capital via premiums to these policies that we own. But we're going to want to have a certain amount even more readily available for our use. So have an emergency fund. Here's a real quick tactical point about emergency funds. I loved it when I heard this for the first time. I believe I heard it from Caleb Williams from Better Wealth when he talked about when an emergency fund is big enough, it becomes an opportunity fund. So imagine you meet that goal of, well, I want to save for 6 months, or I want to save for 2 years of living expenses, business expenses, however you want to plan that out. But once you go beyond that, then if you double that amount, whatever that amount is, haven't you created a fantastic opportunity fund for yourself? And there's actually a rule. There's a rule about this, y'all. It's in the book. It's called the golden rule. He who has the gold makes the rules. And it goes like this. When you intentionally accumulate capital, opportunities will hunt you down. That's right from R. Nelson Nash. He said they will seek you out. And he gives some examples from his own life. And I found that to be the case. I found that to be the case that when Lauren and I started intentionally building capital in these policies, we had opportunities presented to us for us to be able to do family lending. And we've done some real estate. We've done different things where he who has the gold makes the rule. You're in the position of control. You're in the position of opportunity. So that's one thing that I would say about an emergency fund. When you make it big enough, it becomes an opportunity fund. Now, when it comes to other places where people typically put money or where we're encouraged to put money, here's a big category, and it's going to be retirement/investing. Now, here is a big difference that I want to make. Folks will say saving and investing interchangeably, but they shouldn't. Saving money is keeping it. Investing money is putting it at risk for potential gain. Did I say that right? Potential gain. I think I said potential. Potential gain. Those are two very different things. We should save an emergency fund. If we choose to invest, that's different. Now, having been, again, like I said, a law enforcement officer, a teacher in the state of North Carolina, those are both very static, stationary, traditional roles where you have an employer who has these plans, programs, etc. I even had obligatory withholdings from my pay all of those years. There's nothing that I could change about it. The state was going to take a significant percentage of my earnings out of my paycheck and do something with it. So I'm mentioning that because it bothers me. Because I have good ideas about what I could have done with that. But be that as it may, each year somebody came to the front of the room to talk about, well, you should be doing this, you should be doing that. Again, I'm not giving advice right here. I had those qualified plans and I was paying proactively, voluntarily into those qualified plans on top of the state retirement programs, etc. And what I want to say right there is just be aware. The first time that I was challenged by a mentor to consider what I really knew about qualified plans, it really struck me because he said, Jesse, I'll bet you don't know more than two things, if you even know those two, about your 401k. He said, I bet you might know whether, according to your quarterly statement, the amount went up or down for that quarter. And he was right, and I did. I checked the mail. I checked that statement each quarter. I knew whether my number went up or down. The second thing was he said, maybe you also know, maybe, whether or not you have a mild, a moderate, or a more aggressive setting on your risk tolerance with that program. And he was right. I did know that. And he was also right that I didn't know anything else other than those two things. That was it. I'd really never considered what it was going to look like for me as a young man in my early 20s, married, starting my career, to lock up money that I had put at risk for the next 40 or so years behind that penalty. And so all I'm saying is be aware. Penalties, fees, access, red tape, the risk that you're assuming, so many factors. And again, this isn't advice. I'm just asking you to be aware. And I am promoting the idea that you can control and profit over the capital that you experience in your life in a guaranteed, tax-free fashion. And here's what we know. You are going to finance everything. Remember that? You are going to finance everything that you ever do. Well, when you catch on to the fact that banks are making money off of your money, off of all of the cars and the homes and everything else that you are financing, if you could earn that guaranteed, everything else would pale in comparison, to include these average rates of return that are touted in markets where there's risk. So again, I'm not saying that you have to pick and choose. I'm not saying that you should do infinite banking versus invest. So what I'm saying is everything's finance, to include investments. What if you just took over the banking function in your life and then you still ended up doing whatever investing that you wanted to do, whether that was with programs or with something that you directly decide to lay hands to, whether that is real estate investment, something in the crypto world, like, again, whatever it is that you would have done anyway, everything's financed. Banks are making money off of your money. What if you owned and controlled that operation and then you still went out and made whatever investments that you wanted to? You can do both, but for sure you should do the one, which is the banking. You could do that for yourself. You could profit for that for yourself. All right, and then let's go over to college, because one of the big things that we're told to do, and we should probably address this for ourselves. Like I said, when I learned about infinite banking, I had already been paying on my student loans for years. So I already had student loan debt for myself. So of course, now we can talk in the context of, do you have student loans? Would you like to pay off your student loans and keep the money at the same time? Because you could do that. You could do that with infinite banking. You could start the infinite banking process for yourself, pay off your student loans, and grow appreciating assets for yourself at the same time. Okay. And then if you're like me, before 40, you're a young parent and you're looking ahead at college for children, college for grandchildren, and you're wanting to proactively do something for them. Is there a way, now that you're aware, for you to be able to grow and compound your money, still maintain access for it without the penalties and fees that you find in other programs that are touted for their use with college preparation, and do both? So could you be growing assets that you'll own and control for your whole lifetime, and then use those assets to provide for your college or further education needs when it comes to the kids and the grandkids? Yes. Yes, you can. So that's another conversation that I for sure wish I'd have been able to had before I took on student loans. But of course, that's also now what I am setting up with my wife for our children, and then of course later on grandchildren, and so on. Because I'm a big believer in further education. In fact, if I gave you some rapid fire thoughts real quick about what I would suggest for folks that are just looking to improve themselves financially prior to age 40, I would say start a business, go to seminars, build a physical library of books for yourself that you actually read, autobiographies, personal growth and development, finance books. I would say join networks, join clubs, start something, start some community, start some network. Journal, record yourself, become a communicator. So I would say lots of things right there, because that's been my experience, that so much of the value that I can attribute to my life prior to 40 was starting businesses, meeting new people, putting myself in uncomfortable situations, talking to folks, whether it's in this way or whether it was at live events or just attending events, so many different situations, putting myself in uncomfortable situations or doing what most people don't or won't do has been to my benefit. In fact, just in general, I've kind of adopted this approach that if most people are doing X, I should be considering doing Y. That's just where I'm at. So there's a little bit of rapid fire food for thought right there. But we were talking about college. Can you save for college and keep the money at the same time? Yes, you can, because of infinite banking. Charitable giving. Let me talk about that one. For my whole life, I have been taught, and I love this principle. I believe that it's biblical. I believe that it's just good. It's a good habit. It's a good practice. But I have a scriptural foundation for doing so myself. I've paid a significant percentage of my earnings charitably to our church and to other areas. Knowing what I know now about infinite banking, what I'm telling you is prior to the age 40, I mean, again, that could potentially be right up to 40 years of charitable giving, such as was my case. What if you could continue to give charitably, but you added that one step, just like we've been talking about in all these other scenarios? What if you directed that cash flow to a private money system first, where it's going to grow, going to compound, going to create a income tax-free windfall to your heirs or beneficiaries, which again could include the charitable organizations, churches that you care about. You can give more in your lifetime because of that growth and that compounding. And then again, because these whole life policies eventually culminate in a death benefit going to somebody, you can give beyond your lifetime, which is just incredible. It's a great way to level up your charitable giving. And most people that do charitable giving, they're using some significant percentage of their cash flows to do that. So I'm saying you can take that to a new level. The next tactical point that I would give you is to consider when it comes to housing, rent when you got to rent, buy when you want to buy. I'm not going to tell you one versus the other. You choose what you want to do. I would say this. If you're infinite banking, you can rent more efficiently. Again, we just talked about the golden rule. If you have the capital to go to the landlord and say, hey, I'd love to pay for the whole year right now. Could I get a couple months off my rent? And if you could save yourselves 2 months worth of payments, that's a big deal. So it's still you renting because you want to rent, but it's doing it in a more efficient way where you've, number one, gotten multiple uses out of dollars. Those dollars were building an asset for you first, which was the policy, which created legacy, created cash value, allowed you to be able to earn a dividend from that company. Lots of things are happening because of that $1 that you paid into that policy first, but then you still got to use that policy to go out and pay the rent. And possibly even at a discount. What if you could take a month off, 2 months off of that rent? You saved yourself money while also having all the advantages of building the asset. Now, when it comes to a home, I'm going to suggest that you consider a 30-year mortgage versus say something like a 15. And I know that there are strong, powerful voices that are going to say, no, go the 15 route. Where I'm going to say 30-year can come out ahead, and I understand the human problems. I understand that structure can help us. So I understand the thinking and the math behind the concept of 15 being better than a 30-year mortgage. But here's what I would say. I value control and flexibility very highly. So if you have a 30-year mortgage, can you still, with your own choice, your own autonomy, decide to pay that in 15 years? Yes. And then is the math? Yes. Okay. But then you also, if you hit some unexpected roadblock, again, we've already talked about having an emergency fund. That should be there too. But if that happens, you have the flexibility to just be paying the smaller payment for that month, that year, just depending on what kind of storm you're weathering, because you're on a 30-year track. And then you could get back to the more aggressive payment plan that you set for yourself when you choose. So that's a real tactical, nuanced point. And yet I feel that it's so, so important. Again, if we're first and foremost sending our dollars to policies that are creating cash value for us, death benefit, can be earning us dividends, etc., and then we could still use that policy to pay extra towards the mortgage, we're getting much more of an efficient use of our dollars and yet still maintaining more flexibility by being on a 30-year track instead of a 15-year track. But at the end of the day, human behavior is always human behavior. And those are the biggest problems that we all face. Those are mentioned in the book. The tendency to spend all that we earn. The tendency for people to try and steal money from us. Again, enter inflation, taxation, etc. Okay? We still have to confront those human issues. No question about it. But tactically speaking, I'm going to encourage you to consider, if you're going the mortgage route, 30 years versus 15, and do it the infinite banking way. And then one more bonus point, which is warranties or unnecessary coverages. Like Nelson even talks about in his book, the way for you to not just finance cars, let's say for yourself, but to finance some of the coverages that you would want, but not doing it the conventional way, where companies are just leeching off of you for something that's not likely to happen. Could happen, so you should prepare for it. But Nelson is saying, well, prepare for those collisions, not the liability stuff, right? That's the example that he uses. Is, of course, you want to have liability coverage, let's say, with your auto insurance. But do you need the collision? Do you need that coverage that's costing you something that's like a leech sucking money off of you every month or every year for something that's just really not likely to happen, but that you could still proactively plan for if you've built a robust emergency fund, contingency fund, opportunity fund, as many funds as you want, of course, in a system of policies that you own and control. And again, for those of you that are implementing infinite banking, looking at implementing infinite banking, leveling up your infinite banking prior to age 40, and again, for those that are beyond 40, this is still for you. The eventual goal here over our lifetime is to get our income to equal premiums. All of our money currently goes through conventional banks. We eventually want all of our money to go through our private banking system. And as you're leveling up to that point, and Nelson says it might take the average bear 20 years. So if it'll take the average person 20 years to get there, some will do it quicker, some will do it slower. That could be something that we eventually account for ourselves, which is the replacement of that phone or the replacement of that car, just because we have control and access to capital. Now, let me recap by giving you this. I've talked for a while about a lot of things that, again, I just want my children and my grandchildren to hear. And I believe it's going to be helpful to you, whether you're younger than 40 or older than 40. But consider the opposite of what I've said here. This is one filter that I always like looking at any idea with, is just look at the opposite. Ask yourself this: should I be completely unprotected in the event of when I die? Do I want to leave my young wife and children with nothing? Financially speaking, there are a lot of other areas where they will be hurt. But financially speaking, and this isn't me fear-mongering, we're going to graduate. I'm going to graduate. Thankfully, and this has not always been the case, but as of this year, 2025, I actually maxed out my insurability. I could not get another policy as of today, and that's a moving target. The case will be different as I move forward in life, God willing. But as of today, I could not get more coverage. I have so much that the insurance companies will not let me have anymore, even if I asked. So I practice what I preach. But think of the opposite. Do I want my wife and children to have nothing or too little? Because that's the opposite of what I would encourage. I can't have too much for my family. That's my philosophy. Think about the opposite. Do I want to have no emergency fund? Do I want to have to run to the ER with my bleeding son and not have an emergency fund? Do I want to experience a shutdown in my industry? I've experienced that. Company contract evaporated. Completely out of my control. It was an industry-wide change in 2020. What about a job change? What about a layoff? What about, I deal with these things all the time. Do I want to have nothing ready for that? Do I want to be drowning in debt? Do I want to have nothing prepared for my children's future, whether they're going to go into the military, get married, start a family, start a business, go off to college? Do I want to prepare nothing for those things? Do I want to plan to have to work to the day that I die? Now, I don't plan on retiring personally. That's just my personal philosophy. I want to advance only in my life. I don't want to retire. I want to have passive income, no question. But do I want to plan to have to work until the day that I die? And then here's a big one from me. Should my next generations have to start from scratch like Lauren and I did? For me, the answer is no. So I want to proactively plan for these things. For me, infinite banking is the way that I do that. That's how we are living and leaving a lasting legacy. So if you learned more about how to live and leave a lasting legacy, make sure to subscribe to our channel here. Hello and welcome to the Durham Talents Town. It's my core belief that you are your most valuable asset out of all, which again, those are the big things where those, I feel like I've got